Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Valero Energy Corporation, ticker symbol VLO. So we're looking at Valero Energy today as a subscriber request. Currently, their stock is trading for $136.13 per share, and Valero Energy is up 61% over the past year alone. So we want to find out today, what are we missing? What could the market have possibly discovered about this business this year that's led to this outperformance? So over 5 years, Valero Energy is up 38%. They're compounding at a rate of 6.5% annually. The business is up more than 3 times from their March of 2020 lows. Over 10 years, Valero Energy is compounding at about 13% annually. And going back prior to the global financial crisis, over the last nearly 18 years, Valero Energy is compounding at 10% annually. Keep in mind that the company does pay out dividends. Right now, management has a stated goal of paying out 40 to 50% of operating cash flows as dividends, and Valero is currently paying out a 2.9% dividend yield. So their average dividend throughout this 18-year time frame would be in addition to this 10% compounded annual return. Valero is just $10 below their 52-week high. They're up nearly double from their 52-week low. Right now, around 3% of their shares outstanding are sold short, and Valero is a large business. They have a $52.5 billion market cap. For additional background about the company, Valero Energy is one of the largest independent refiners in the United States. It operates 14 refineries with a total throughput capacity of 3.2 million barrels a day in the United States, Canada, and the United Kingdom. Valero also owns 14 ethanol plants with capacity of 1.7 billion gallons of ethanol a year, and holds a 50% stake in Diamond Green Diesel, which has capacity to produce 700 million gallons per year of renewable diesel. The company was formerly known as Valero Refining and Marketing Company and changed its name to Valero Energy Corporation in August of 1997. Valero Energy Corporation was founded in 1980 and is headquartered in San Antonio, Texas. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic beginning understanding of Valero based off of their business fundamentals. So this analysis is still an evolving process. It's a work in progress, and it's an opportunity to learn in public. So it will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 key reasons for this. The first is that the average publicly listed business earns about a 7% return on capital. And the second is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. And these business returns are going to be captured here by return on capital. So by looking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Valero's return on capital has fluctuated somewhat over these last 5 fiscal years. Their returns on capital were negative in 2020 amid the COVID-19 pandemic lockdowns and with the dramatic price drop in oil. Since then, the price of oil has risen. In 2021, the company produced about 5.5% returns on capital, and over their last 12 months, Valero has produced an astonishing 32.5% returns on capital. So that is far outpacing how they performed over these past 5 years. As a petroleum refiner, the company will be cyclical in nature, given that it operates in the cyclical oil and natural gas business, which is a commodity business. So we're seeing returns on capital that have fluctuated along with the pricing of these commodities, and it's likely that that commodity pricing will have a significant impact on Valero going forward as well. So averaged out over these last 5 fiscal years, Valero is only averaging about a 7% return on capital, although their numbers have been pretty much all around that, and they have not earned that specifically in any of these 5 years. Even still, that's just about average returns on capital, and that's only half of that 14% benchmark we were looking for. So this is an X to start things off here on metric number 1 for Valero. Next up, for metric number 2, we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the past 5 years. This metric will be all or nothing in nature, with either all 3 of these being up for this to be a check, or if even one of these is down, this entire metric will be an X. We'll also be taking into account their last 12 months worth of numbers in our calculations here. So over this time, Valero's revenues are up by 87%. They brought in more than $160 billion worth of revenues in their last 12 months alone. Their earnings are also up more than double, although it is worth pointing out that both their earnings and their free cash flows were negative in 2020. And over this period, their free cash flows are up by more than double as well, with Valero bringing in $9.2 billion in free cash flow in their last 12 months alone. This is strong growth across the board here for Valero. Between these past two metrics, we really do see the negative impact that COVID-19 temporarily had on this business, but in both their returns on capital and their strong free cash flow production, Valero has recovered from this quite nicely. So this is our first check of the day on Valero, and it's especially great to see that they've had such strong free cash flow growth, because free cash flow is really the lifeblood of any business, and a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is ultimately what that business is going to be worth. So a business can use its free cash flows to reinvest back in the business, pay dividends, buy back shares, make acquisitions, or pay down debt. So again, it's great to see such strong growth for Valero here. Then next up for metric number 3, here we're taking the perspective of an individual shareholder in the company by looking at Valero on a per share basis. So we're looking for earnings per share growth over the past 5 years. So we learned in our previous metric that Valero has more than doubled their earnings over this time. However, we still want to see what the company has done in terms of their shares outstanding, as shares are the denominator in this earnings per share equation. Likely a strong sign for long-term shareholders in the business, Valero has actually repurchased around 9% of their shares outstanding over this time. That's really great because when you purchase a stock, what you're really buying is a fractional ownership percentage in that underlying business. And so when a business buys back shares by decreasing the amount of shares that they have outstanding, they're increasing your ownership in the business, which is ultimately going to increase the percentage of the business's profits that you're entitled to. And they're doing this without you having to spend a dime. So it's almost as if the company is making a partial acquisition of itself. And so just like with any other acquisition, we want the company to be getting more value than the price that they're paying. You'd have to dig in to understand at what prices and valuations Valero was buying back their shares at. However, between increased earnings and 9% share buybacks, Valero's earnings per share are up. So this is a check here on metric number 3. And over their last 12 months, Valero has earned $23.35 per share, which is more than double any of these previous years. Next up, metric number 4 is going to be very similar. So here we're looking for free cash flow per share growth over the past 5 years. So this is going to be almost the exact same as their earnings per share, as their free cash flows per share are also up more than double. Coupling that with their share buybacks, this is strong free cash flow per share growth for Valero. This is another check here on metric number 4. Over their last 12 months, Valero has produced $22.80 worth of free cash flow for each share that they've had outstanding. And so far through our first 4 metrics, we have 3 checks and only 1 X for Valero. Next up for metric number 5, here we're evaluating how the business utilizes debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. We want their net debt, which is their total debt minus their cash and short-term investments, to be below the amount of free cash flow that Valero has produced over the past 5 years. So Valero did take on debt coming into 2020. This is when the business hit its peak net debt position, although they had been steadily adding on to their debt load prior to this. Since their 2020 peak for their net debt, they've been steadily paying this down, and they've really prioritized doing that along with their stated 50% dividend payouts. So Valero ended 2021 with $11 billion worth of net debt, and currently the company has $7.6 billion worth of net debt. Over these past 5 fiscal years, Valero has produced more than $13 billion worth of free cash flow, and the company has produced $9.2 billion worth of free cash flow over their last 12 months alone. So they'd be able to pay off their entire net debt position with only 1 year's worth of their current free cash flows, and they're able to support this on a historic basis of their free cash flows. So this is another check here on metric number 5, as it looks like relative to the amount of leverage that Valero is using in their business, they're strongly cash flow generative. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give us a slight risk premium to the yield of the 10-year treasury, and it'll give us a starting point for a reasonable valuation of Valero. Right now, Valero has about a $62 billion total enterprise value, so we're using their total enterprise value because it takes into account both their market cap and their net debt position, and it's going to give us a perspective of the economic reality of the company that's more similar to as if Valero were a private business. So we learned that over the last 5 years, Valero has produced $13 billion worth of free cash flow, meaning that in an average year, Valero produces $2.6 billion worth of free cash flow. So when we divide their $2.6 billion of their average free cash flow by their $62 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of about 4.2%. So while that is slightly above the yield of the 10-year treasury, that's below that 5% risk premium that we're ideally seeking. And so on a historical basis of their free cash flows, this is an X on metric number 6 here for Valero. Things look differently though when we're looking at their current free cash flows. As we previously learned, the company has produced $9.2 billion worth of free cash flow over their last 12 months. So to get a current free cash flow to enterprise value yield for the business, when we divide their $9.2 billion of their last 12 months of free cash flow by their $62 billion total enterprise value, that gives us about a 15% current free cash flow to enterprise value yield for the business. So that does look like that would be significantly above that slight risk premium we're ideally looking for. So because these two are split, and because they do have average historical cash flows that are higher than what the treasury is right now, it's likely worth your time and energy to dig in and learn more about Valero here, as it does look like the company is interesting, especially if the price of oil would continue to be higher into the future, like it has been over the past couple of years. However, keep in mind that this is not financial advice. This analysis is meant to be taken in holistically, and this is only one of our 6 metrics here. While these metrics are simple, when they're combined together, they can be very powerful. And we've still got some interesting stuff to uncover about Valero. Then as a bonus here, we're looking at Valero's dividend profile. So again, Valero currently pays out a 2.9% dividend yield, which is better than that of the yield of an S&P 500 ETF. Management also has a stated goal of paying out 50% of their operating cash flows as dividends, and they've stated that they want to maintain dividend payouts throughout the entire commodity cycle. So that looks like that was the case here when we're looking at their past 5 years of performance. Even when the business had negative free cash flows in 2020, the company did still pay out these dividends, and they even took on extra debt to be able to support this dividend load. So while that is going along with what management's stated outcomes are for the business, that was a potentially risky capital allocation decision, especially if the business's free cash flows would not have rebounded so quickly and so dramatically. However, in all of these other years, Valero was easily able to support their dividend payouts with the amount of free cash flow that they were bringing in, and this is especially the case over their last 12 months. Again, the company has brought in almost $23 worth of free cash flow per share in that time, and it looks like the company is using a very reasonable amount of leverage relative to the free cash flows that they're currently bringing in. So it does look like the business will likely be able to continue supporting this dividend payout, and as they have it pegged as a percentage of their operating cash flows, that while it could go up or down, it's likely to still be paid out to shareholders nonetheless. So while this is looking at the past 5 years of performance, it does seem like it would be the case that Valero would go along with what their management has currently stated in terms of their dividend payouts moving forward into the future. Then everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Valero, which takes us on to using a discounted cash flow model to come to a potential fair value for the business. A discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with an average of their free cash flows over their past 5 years to give us a more normalized perspective of the business. Then we're using growth assumptions to project how Valero Energy is going to grow their average free cash flows into the future. So it's up to you to do your own homework here to determine whether or not these potential growth assumptions are going to be accurate or applicable going forward to give us a baseline projected estimate for Valero. So assuming a growth stage over the next 10 years where the company grows their average free cash flows at a rate of 5% annually, then assuming a terminal stage for the 10 years out after that, where they grow their average free cash flows at a rate of 4% annually, if we add in the company's tangible book value, which accounts for their net worth, and we were ideally seeking a 15% rate of return for Valero Energy, then it looks like a fair value for the business is just under $143 per share. So it does look like at today's current stock price and with today's current valuation multiples that there would be a slight margin of safety for the business. Please keep in mind some caveats here. One, this discount rate would be including their dividends, so we would not be doubly counting their dividend yield. So 2.9% of this 15% return would be coming from their dividends. Two is that this fair value does rely on the company maintaining its current valuation multiples. And then number 3, as Valero Energy operates in a cyclical commodity business, their future cash flows may not necessarily be as predictable as the cash flows of some other businesses. So that's why it's really worthwhile to dig in and learn more about the company and have some sort of educated understanding of how the supply and demand dynamics are likely to work out in the oil and natural gas industry. Then please be mindful of the fact that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. In just a minute, we'll talk about our summary for Valero Energy, but we have to address something first. What are some of the qualitative aspects about this business, especially those that support the key points for either a potential long or a potential short thesis of the company? So starting with some of the key points around a potential long thesis for Valero, number one, management has committed to maintaining the dividend throughout the cycle while returning cash to shareholders with a specific target of 40 to 50% of operating cash flow. Number two, Valero is investing in renewable diesel, which should increase volumes and provide attractive returns, given global blending mandates and favorable renewable fuel credit treatment. And number three, Valero enjoys a cost advantage thanks to its proximity to cost advantage like crude oil, ability to process discount heavy sour crude, and low operating costs from lower domestic natural gas prices. Then for some of the key points around a potential short thesis of the company, number one, refining capacity in Asia and the Middle East is growing rapidly. If regional demand does not materialize to absorb the extra production, U.S. refiners may not be able to export as much refined product as necessary to balance the United States market. Number two, Valero benefits from light and heavy crude differentials in the United States. Those differentials could remain narrow on increased pipeline capacity and less supply. And number three, growing EV adoption will likely result in gasoline demand destruction and could potentially leave Valero's refineries uneconomical, given the high proportion of gasoline production. So there you have it. Hopefully that offers a potentially balanced perspective around some of the key points for the business. Now it's time for our wrap-up. So in summary, Valero Energy checks the box on 4 out of our 6 metrics for the Select 6 analysis. The company is maintaining a dividend payout of 50% of their operating cash flows. Their current free cash flow to enterprise value yield looks like it's potentially offering a significant risk premium to the yield of the 10-year treasury, although their average free cash flow to enterprise value yield was just slightly above that of the yield of the 10-year treasury. Based off of their historical and their current abilities to produce free cash flows, it looks like the company is using a very reasonable amount of debt in their business. Then, over the past 5 years, not only has the company grown their revenues, earnings, and free cash flows very strongly, they've also bought back 9% of their shares outstanding over this time. So it's great to see that even though the business had a rough go of things in 2020, that the company did not excessively dilute shareholders, although they did add on some debt in that year. However, they've steadily paid that off. Then, even though the company has very high returns on capital over their last 12 months at 32.5%, over the last 5 fiscal years, the company is just producing typical returns on capital, averaging out at about 7%. Then finally, performing a discounted cash flow analysis of Valero. If you've done the work and you believe that those assumptions are going to be potentially applicable for the business going forward, then it looks like from today's valuations of the company, if you were seeking a 15% rate of return for Valero, that the company would have a slight margin of safety in its current stock price, and that the intrinsic value of Valero Energy would be north of $140 per share. So again, because of some of the reasons we mentioned, that may not be potentially accurate for the business going forward. So it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Valero Energy. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. As a value investor, you ultimately want to learn about a business as if you're going to own 100% of it, and you can truly understand the ins and outs of that company and understand what's important and what's not important for the company going forward. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Valero Energy, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Valero Energy Corporation, ticker symbol VLO. Again, we looked at the business as a subscriber request today, and Valero Energy has significantly outperformed much of the rest of the market over their past year. Plus, it looks like the company has some interesting qualitative edges. So I'm happy to make an analysis of the video, and if you learned something today and or you enjoyed today's video, please be sure to like the videos, subscribe to the channel for more stock analysis videos, and comment down below what company you want me to take a look at next time. Thanks for learning about Valero Energy with me, and have a great day.